Welcome to Buy, Hold, Sell. My name is Matthew Kidman, and today we're talking about small caps, micro caps, those little stocks. We're dancing with the devil, high risk but high reward. And to talk about, we've got Mark Devcich from Pi Funds and Stott from Wilson Asset Management. Chris, I'll start with you. When you're investing in small caps, are there some rules that you must abide by that you can't afford to get away from?
Yeah, to us, Matthew, the key is free cash flow. How is their cash flow? Net cash on the balance sheet is always a very positive sign for us in terms of finding these micro caps. But cash is king, and reconciling that cash flow to profits is also incredibly important. And second, the second key thing that we look for in any stock, in particular a micro cap, is management. Have they been there before? Have they executed experience in a listed environment, running companies? So to us, those are the two key factors that we look at when assessing it for any micro cap opportunity.
Just on that balance sheet, so when you see the balance sheet, you like to see for the first time net cash rather than no cash or debt? And
how they got to that cash position also. Have they generated organically, or have they raised money to artificially look at the balance sheet looks okay? But free cash flow is really the most important thing that we look for when analysing a company's financial statements.
Okay, Mark, add something to that, or the same kind of thing comes out in how you look at it?
Yeah, I guess the first point is we really like checklists because checklists force us to focus on process. Right. And generally, good process leads to good outcomes. And then on our checklist, so I was recently redoing our checklist. We've got 76 points on there.
76?
So it's not 76 individual points. Some are weighted up to 4 points. And some of the higher weighting scores are things like, does management have a large shareholding in the business? So generally with small caps, you're dealing with CEOs who are the founders of the businesses. They've already got that large shareholding, so they're aligned with outside shareholders, which is a good place to be. When you don't have that and the CEOs come to the business later on, you're looking at their remuneration and how they're incentivized. So if they're incentivized in a way that's going to create value for shareholders, that's something we really like.
Okay, Chris, do you look at that? Do you look at whether the management have got a fairly incentivised or already own a lot of shares?
In addition to Mark's comments, absolutely that's critical, how incentivised they are, not only with their individual shareholding, but also to perform thereafter. What are their STIs or LTIs as they call them? Whether they're EPS related or total shareholder return related, they're typically the two that we prefer those in terms of on the medium to longer term outlook. But how those individuals are key man risk, how has that been addressed, particularly within a micro cap where the management layers are a lot less than say compared to a medium or a large cap company that's listed on the ASX.
Okay, Mark, we're not going to get through the whole 76, but let's jump down a few. You've given us, you like your management to have some kind of skin in the game.
Exactly, yeah.
What give us another big one?
Another key one would be, is the business operating cash flow positive? Especially in micro caps, they're not often positive operating cash flow. So that leaves them at risk of having to do desperate capital raisings. So if you're operating cash flow positive and you've got a good balance sheet, destiny's in your own hands. Whereas if you're burning cash, you're going to have to raise from the market. The market's not in a good mood. It's going to be heavily discounted and there's going to be a lot of dilution, which is not good for existing shareholders.
So you're with Chris on that one. But Chris, we all know, looking at small caps, there's always that chance that you get them early in the business cycle and there's a fantastic future painted for you. And sometimes you say no and you see them go up. So how do you handle that when the promise is out a couple of years?
It's interesting. Some micro caps can be good in the sense that, iProperty was one a few years ago where the company weren't making money for 4 or 5 years, but they had a management team that had been there and done that in the sense that they were involved in the early phases of realestate.com.au here in Australia and the success that they've had. So they were trying to emulate that over in the Asian region, and so that was a company slightly different in the sense that weren't generating any cash, but you're really backing the management quite heavily in that scenario. And there are ones that you do miss and watch them go up, but you just really need, and as in our job, it's a day-by-day decision-making game, and you really just assess the cards that are in front of you on that particular moment in time.
Okay, Mark, unlike big companies, especially the big top 20, small caps can go broke, which is unusual, and you can lose all your investment. Do you spend much time on thinking, how do we mitigate that risk?
Yeah, I guess that goes back to the cash flow point, and then following on from that to the balance sheet. So we like to see net cash balance sheets. That's a key one. And I guess the other point is we try and invest in small caps that are growing revenue, and that at least puts them in a position to get bigger over time. And that's something we really need if we're going to invest in a small cap, because our investment philosophy is invest when it's under research. Hopefully the small cap grows, it gets bigger, gets picked up by larger fund managers, broker coverage starts, the valuation multiple increases, and that's investment thesis. So we need them to grow revenue and to keep increasing profits, and then that gets them over the line to when they're a more stable business.
And what about liquidity in a stock?
That's a tough one for microcaps. It's a perennial, difficult question. Yeah, often it's bad because you've got the management teams holding a big chunk of the.
So you just got to take on the risk.
You got to take on the risk, yeah, and yeah, hopefully stack the odds in your favour.
Chris, liquidity. It's always a question in microcaps.
It's critical, and as you said, Matthew, small caps can go broke, and they do. So it's really important to stay nimble. So we assess liquidity all day, every day, particularly when we're looking to take a new position in a company. We'll assess the average daily volume of that particular stock and how long it would take us to cut that position if something did go wrong, and things do go wrong. So we spend a lot of time on liquidity, not only on the initial purchase, but on a regular basis, on a monthly basis, right across the portfolio, trying to get a grasp of where the risk lies if something does go wrong, and that's really critical in microcaps, where it's critical that you stay nimble at all times.
It's tough, but it seems like there are ways you can dance with the devil and get away with it.